Welcome back. Good morning, good afternoon, good evening. Thank you guys once again for joining the 9 Innings podcast hosted by yours truly, Kevin Thompson, founder and CEO of Capital Group. Thank you guys for joining. As I always say, subscribe to the channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your questions. Go to the website at www.9icapitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Follow us on all social media channels at 9iCap or at MLB2CFP. I know you guys see the divide right now versus Main Street and Wall Street. Markets are at all-time highs, yet unemployment is starting to creep up. Inflation is hitting your pocketbooks, and I am here to tell you why that is today. Why there's such a discrepancy between Main Street and Wall Street. You don't want to miss this episode. Let's get it. So welcome to the show. As you know, we like to educate, and today this is what this episode is about. So why does the market continue to grind higher when Main Street feels like it's being left behind? We've got rising unemployment, more people looking for jobs than are available, which is going to put downward pressure on wages. Inflation refuses to roll over, especially in basic goods like food and energy. I know you saw the numbers recently. Yet, you turn on CNBC, Bloomberg, the S&P is going ever higher. Markets are great. Manufacturing is great. Capex spending is up. It doesn't make sense at first glance. So let's really break down this disconnect. So the Fed's in a dilemma. We know this. They're trying to combat inflation, keep unemployment in check. But the inflation right now has been the one that's been the biggest issue for Jerome Powell. It's been sticky because of food, because of housing, because of energy. On top of that, you have tariffs slowly creating a little bit inflation, seeping into the market very, very slowly. At the same time, they're staring rising unemployment in the face. That's a nightmare situation for a central banker. On the one hand, they need to cut rates to provide relief and keep markets flowing, to keep capital flowing to the capital markets. On the other hand, they want to make sure that employment doesn't get too bad. So what do? They've already started guiding markets to a quarter point rate cut, maybe a half a point rate cut, or rate cuts coming soon. Not because the economy needs it, quote unquote, but because they need to keep credit flowing. But here's the kicker. What do rate cuts do? Well, if you're in a money market right now, rates start coming down, you may start looking for alternative situations there. You may take that money out like, well, hell, I need to put that money somewhere. Where else can I put it? Because I want to get a rate of return. If you're getting 5% just sitting in cash today or 4%, you don't have to buy stocks. You can just sit there. They know this. And that's where inflation comes in, because now you're saying, okay, well, where do I go? When the Fed cuts that yield down to, say, 3% or even 2%, suddenly investors are pushed back into risk assets like equities and real estate. That artificial push is part of the reason the markets stay resilient when the economy feels fragile. There's just really nowhere else to go. Nowhere else to go, which talks about Tina. There is no alternative. That's what it feels like right now. Besant came out and said it. If you don't own assets, you're falling behind. And by saying that, you're forcing people to say, well, hey, my wages are stagnating because of what I mentioned previously about there's more people unemployed than there are jobs available. So therefore, supply and demand would say that either wages would stagnate or come down. But prices are moving up. So the only way to offset that price increase on grocery, houses, food, gas, whatever, would be to invest in assets. And that's what he's saying. So where else are you going to put your money? Bonds? Sure. But yields fall when the Fed cuts. But when yields fall, that also means prices rise. So there's an opportunity there. Not saying that is not advice, by the way. And again, bonds have rallied over the last several months. Real estate, illiquid, locked up. With most homeowners sitting on sub 4% mortgages, they're not moving. I'm not moving anytime soon. Mortgages in the low threes. Why would I move anywhere? Commodities, volatile, and usually a hedge rather than a long-term store of value. Gold just took out its inflation-adjusted return recently. Inflation-adjusted return, which means that the actual dollar value in the gold that you invested is actually over its inflation-adjusted return, which when you adjust it for inflation, that's the actual value. So as Besson said, like I said, if you don't own assets, you're being left behind. That creates a forcing mechanism. Either be in the market making something or be out of the market and struggling to keep up. So even when Main Street is hurting, higher grocery bills, higher energy costs, stagnant wages, money still flows into the market because the alternative looks worse. That's why resilience sometimes feels like delusion. So there is no alternative. Let's talk about the housing conundrum right now. The Fed is also desperately trying to unlock the housing market. But here's the problem. Millions of people, like I mentioned before, are sitting on mortgages under 4%. Nobody wants to give up that to buy a house today at prices that have appreciated substantially with higher rates. What sense does it make for me to go and buy my house where it is priced today at a 7% or a 6.35% mortgage when I'm way lower than that? Half of that. Makes no sense. So rate cuts might help around the edges, the new buyers coming in, but they won't suddenly convince homeowners to move. There's a large swath of assets there that ain't moving anytime soon. The housing market is stuck. And it's one of the biggest drags on Main Street right now. For markets, that just means money looks for opportunities elsewhere. But here is what I'm going to tell you, and this is not advice. The appreciation of your house matters. If you are an individual that is paying PMI, there's an opportunity to get that wiped away due to the appreciation of your home. If you're an individual that has significant equity in your house, there's an opportunity to get some of that equity out via home equity lines of credit. There are significant opportunities here, especially in the housing market, if you're willing to do such things. Now, I was recently at a conference. I love talking to my cohorts. And one of the individuals was talking about Microsoft is revenues are up. Capex spending, they see in the economy up 10%. Manufacturing around the world is doing well. Around the United States is doing well because of infrastructure, energy build outs. All of it's positive for GDP. Ooh. And again, I was about to get angry because I come from a Main Street perspective. And I said, why am I getting upset? I should not get upset because this individual is coming to you from an investor mindset. And that's totally 100% fine. Because if I had that investor mindset, which I do, I'd be saying the same thing. But you have to understand when you're listening to people on TV, the pundits, you have to hear what they're saying and where they're coming from, because a lot of them are what we call talking their books. You'll hear energy is the best investment right now. And then you realize the person saying that is the CEO of an energy company. Of course, they're bullish on energy, on the industry. Same goes for tech, healthcare, and banking. Everyone is talking their book. Everyone wants you to invest your money with them. That's why it's dangerous to blindly follow what you hear on financial news. Every talking head has an industry alignment, a bias, or a vested interest. The reality is markets are resilient partly because of the capital expenditure growth, factories being built, infrastructure spending, energy build-outs. These things add to GDP, right? They do. They add to GDP. But, and this is a big but, that's an investor perspective. It's very difficult to parse the differences there when you're talking about Main Street versus Wall Street. Like I just mentioned, I said a lot of jargon from an investor mindset. That's GDP. But we know 70% of GDP comes from what? Consumption. And when you have higher unemployment, higher costs from an inflation perspective, that reduces the demand and it takes a hit to GDP. But what they're going to tell you is this: the infrastructure spending, the energy build-outs, the investment is going to offset some of the demand. And again, it's a very difficult proposition, especially when 70% of GDP is made up of consumption. And I want to end with this. Like I mentioned to you previously, we have the talking heads. You got to watch what they're saying. But again, it's the investment mindset versus the economics mindset, right? There's a real divide there. Investors see markets as forward-looking. They look at corporate earnings, Capex growth, manufacturing expansion, and say, hey, these investments are building the future growth. But an economist who's looking at the Main Street or the macro side of things, or possibly even the micro side of things, they can say, wait a minute, unemployment is rising, wages are falling, consumer demand is weakening. This looks recessionary. So the investor could say this is expansionary. An economist or the person on Main Street or a person looking from a macro level could say this looks recessionary. That's how you get these separate views on these channels and in these networks. Same economy, two completely different lenses. And that's where the disconnect lies. Wall Street prices in tomorrow. Main Street lives in today. So when you see markets rising while people on Main Street are tightening their belts, you're seeing the clash between those two perspectives. So I hope this has been a valuable use of your time. I like to have these conversations because, again, these are mainly conversations I want to have. I want to get this out. I'm not going to bore you to death. I think this is a valuable use of your time, especially when you're saying, well, geez, S&P's at all-time highs again, crypto's at all-time highs, and gold's at all-time highs, and everything's all-time highs. It gets to the point where it's like, I guess we're doing well. And the fact remains is that the underlying mechanisms, the inner workings of this doesn't look so well, doesn't look so good. Main Street is wondering, well, if everything's working well, why don't I have a job? Why can't I afford X? But Wall Street's like, everything's working well. Market's at all-time high. So it's a big difference, dichotomy between the two. And I am here to tell you today, and I hope you understand that these are the differences. Thank you guys for listening to the 90s podcast. Subscribe to the channel. Go and get my book, Get My Beat to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, engage, also entertain. Follow us on all social media channels at 9ICAP, or at MLB to CFP. Hey, I'm just here to give you the information. Do with it what you wish. Thank you guys for listening. Stay humble, stay safe. I bid you adieu.